Okay. Hello, everyone. Welcome to this weekend's weekly study session. You have to excuse my raspy voice. We've been traveling and caught some kind of flu or something, so got a cough and sore throat. Let's start off by taking a look at the 1-year yield. If you remember, I've talked about this for a number of months, being quote unquote the canary in the coal mine. And if you'll notice, as the market improves, we're actually going to a higher yield. As far as the 1 year is concerned, we went up to that almost 5.5% level. But recently, in this last 4 weeks or so, you'll see as we've broken down and broken down that support level, that level that I talked about, that I thought we needed to significantly or meaningfully undercut. That has led or has coincided with an improvement in the individual stock action. We definitely went from that hard penny environment to a much better environment for breakouts, and it almost looks as if as we broke down in this yield, we've been breaking out in the individual stocks, and that's exactly what I wanted to see. And this is an indication that the rate cycle, maybe in its later stages here, and the economy is going to slow, and inflation will indeed moderate more from here. Of course, the 10-year yield has just pulled back to that breakout point, that 4.25-ish breakout point, ran up to about 5%, and it's now pulled back. So we're going to test that and see how things go from here. If we can rally back on the yield, or if we start breaking down some more. Now, if we do get a lot of softness, some really meaningful softness in the yields from here, the question is, and the question that's being asked by a lot of pundits and economists is, with this yield curve being inverted for so long. And if you go back and you take a look, each time we get the 10-2 yield curve to invert, we get a recession. The shade areas are recessions by usually a pretty decent lead time. We're right on the cusp there before the COVID decline and that very brief, technical recession. But we've been inverted for quite a while here. An inverted yield curve is definitely a forecaster of a potential recession, has a pretty good track record of it. So that's where we've got to wonder, if are we slowing down in the yields, and is the economy, is the tightening and the what the Fed has done going to be overdone? Are we going to quote unquote, as they say, break something? So that's where I would really just shift to. Instead of trying to figure that out, it's really important to watch the market at this point and really tune into what the market's saying. And we're blasting off here, and this is probably initially because of the fact that rates are coming in here, the rate pressure, the inflation scenario is definitely improving, but this is going to lead to that next question, or that next problem, if you will, to be solved, and that is a soft landing and avoiding a recession. So the market has run up, as I pointed out in previous weeks. We've had a number of gaps here, 5 gaps in a row on the Nasdaq. Got that reversal, and again, this is a situation where I can see where I'm sure at this reversal, as soon as we started rolling over, everybody ran in and jumped on the short side, and sure enough, we came right back and stopping those shorts out. So it doesn't mean that we can't pull back here, but you got to be careful here. This is where you get some volatility. You're extended, you're overbought. While the Nasdaq has been basically moving sideways for about 10 days or so, the New York Stock Exchange is playing catch up. Actually ran up here, and I think again this is a sign that we're getting a little frothy here, and we're definitely overbought. Now, overbought is a good thing in the longer term. If you can get significantly overbought and stay persistently overbought, coming off of a bear market low or coming off of a correction, that's what we want to see. But in the short term, it could lead to a pullback. We've got the RSI up around, and again, I don't trade off of these. Doesn't mean I'm not going to buy stocks. I'll still buy stocks, but I'm certainly cognizant of the fact that we're overbought and the market's run up, and we can pull back here. And market type names that are more, S&P type names, or the names that are making up these indexes, again, are probably going to pull back, with these indexes. You got the S&P 500, the percentage of stocks above the 50-day up at those levels that we've seen pullbacks from. So again, just this general run up is a little bit ahead of itself at this point. We got the Dow also ran up 5 or 6 weeks in a row, actually 1, 2, 3, 4, 5 weeks up in a row, got above the 36,000 level. Again, short-term basis, definitely overbought. This has also increased bullish sentiment. Now, some are saying, sentiment is too frothy. Again, short term, yes, we've run up a little bit, but if you take a look at the long term, we're still well below really extreme levels. And the other thing is when you first start a new bull market, if this is starting a new bull market that's sustainable, you'll get the bullish sentiment will move up into those warning levels, and they can stay there. They can stay there for an ex extended period of time. Even if you take a look here, when we came off the COVID decline, we got that bullish sentiment up into that warning area, that 60% of the bulls for the investors intelligence is definitely where we look for corrections from, and we got a short-term correction, but you can see still marched higher, and this was an excellent period for breakouts. This was a real easy dollar environment, and through that entire time stayed pretty elevated with the sentiment, so wouldn't get too freaked out about that if you're hearing that in the news. The longer term sentiment, things like initial public offerings, secondary stock offerings, we're still quite suppressed there. We're not into those real excessive speculative bubble type readings. Take a look at margin debt. This is something where we got a buy signal just not long ago. Has nowhere near the levels that we would say would be frothy. Now, of course, SPY advisor models has turned bullish. These are purely trend based, so they don't factor in any economics or anything other than the price trend. So it's very hard to get off track for any length of time because the models are going to switch and they're going to keep you with the prevailing long-term trend. Recently got a buy signal there. Allocation, of course, is 100% invested right now. Now, keep in mind, we've run up here on the S&P 500, but if you look at the bigger picture, we haven't even broken out of this big base. You're looking at a big sideways action, a big base that's been forming going all the way back to September-ish of 2021, which is great because we're building a great foundation for a potential launch of a bull market here. But we're not even really out of the gate here at this point. So don't you might feel like you missed it, you missed the opportunity. The opportunity has barely begun. Now again, seasonality says that we've got a strong end of the year coming, and again, I certainly wouldn't hang my hat on this and bet on it, but it's nice to see that we do have um, that wind in our sails. Recently, the key components have improved a little bit. We still new highs, new lows on the Nasdaq is lacking, and that's what's keeping it in neutral. The New York Stock Exchange has improved and is positive, but the new highs, new lows on the Nasdaq has not kept pace, and that's that very narrow rally that we've seen, and the market cap being dominated by a small number of names. Major indexes up, down volume, and individual stock participation. If you remember, I had that at neutral last week and previous weeks. I've upgraded that to positive. And I think that we have to say yes, we've definitely seen the individual stock participation improve to the point where we're on balance, we're making money, and things are working. I wouldn't say it's rip roaring, but definitely a big improvement. Indexes are extended, so a pullback or a digestion is certainly possible and probably and likely. I have not raised the stock trading environment model just yet, the STEM model. Have it on cautious. I mean, we could easily say it's easy dollar for short-term trading. This is more of a rear view mirror of sort of a look at what has happened. I don't feel, myself in my own trading, and Mark Ritchie feels like, we should move it to easy dollar now. That now it's just starting to reflect that. I'm on the cusp here of saying that it's really that strong. I don't think it's easy dollar. I think it's tradable, but I think we still have to be cautious. So just keeping that at bay here. But again, you shouldn't be waiting for this. Okay, this is again, if their stocks are setting up, definitely trade those names. Hold on one second here. I just gotta do something. Okay, there we go. Let's take a look. I want to take a look at the S&P 500 again, and we got a buy point. If you look at the S&P 500, you'll see that we got a cheat area or a low cheat setup. It was really classic. If this was a stock, this is a perfect low cheat setting up on a long-term chart. So that was a good buy point, and of course we did get a buy signal on the S&P model around this time as we started turning up. We got a buy signal. Now, again, though, at that time, we weren't getting many stock ideas that were setting up. It took time before the S&P started moving into an uptrend. And again, now you're getting into that uptrend. You've got the 200-day moving up, 40-week moving up, and you're getting into that uptrend. And not until recently, where we had this rally here off that pullback, where we formed this nice big handle and started turning up there. In that period, this 4 or 5 weeks. This is where all the stock ideas that we have as open positions right now, or there's a good number of them, they've all been added and opened during this period right here. So this is where, you have to realize that you got to differentiate between the individual stocks and the indexes. And now, as you see, if you take a look at the IBD 50, this is where we're just coming off the lows and starting to turn up here, but still nowhere near in any type of uptrend. Still trading down by the lows, so we're just starting to see that turnaround. So hopefully we get a shift that ends up becoming sustainable into the type of names that we traffic in. But I think what we have to be cognizant of right now is the type of pullback that we get in the market and what happens with the individual setups, because we could easily see a 3 to 5% pullback, which is historically normal for the S&P 500 under this type of scenario. And that would form that pivot on the right side and complete this base. And that's where you may see a lot of stocks start to set up and you really get a lot more ideas, and it becomes a much better environment for individual stocks versus bottom fishing the indexes here, and then we can start moving maybe into new high ground with the indexes. Now it could happen the other way around. The indexes might take off here, and you don't get a whole lot of stock ideas new that set up, and the ones that have emerged get extended. You get a decent short-term trading opportunity, and we've got to wait for a pullback that comes from maybe a higher level. So main thing is to just, like I said, differentiate between the stocks and the indexes, really focus on the individual names. One thing you can do, for those of you that don't know, if you go on the stock analysis tab, each week, Brandon Hedgepath does a dissection of various names. So he selects names, and there's it's 4, 5, 6 names, and goes through along with the monolith overlay to the right, and goes through blow by blow explaining the pivot points, and if there's a bunch that failed, we talk about the failures and how that was identified, and also the breakouts. So really, for education, this is a really good thing to look at each week. I know some of you might not even know that exists there on that tab. Brandon's been doing a really good job with that. Summarizing, models are bullish. All right, so S&P 500, yes, we're definitely bullish. We'll stay bullish on there until we got those models to change. Seasonality and cycles are bullish going to the end of the year, but short term we're overbought. So a 3 to 5% pullback would be normal for the S&P 500. Like I said, focus on the individual stocks. Mainly focus and look for that right side development. Not only now for current ideas, but going forward, if we get a pullback, look for those stocks that are tightening on the right side and are holding up best during that pullback, and those will be the ones that you'll be focusing on going forward. You want to disconnect from the noise, disconnect from the indexes, disconnect from all the noise about the economy and this and the other thing. You're gonna pick it up in the market. You're gonna see that in the market. Stocks are most likely going to discount it, most likely before we even get any economic real situation that would change dramatically. That would be obvious. The stocks would probably roll over or rally either way, depending on the scenario. And that's why you want to really just focus it on the individual stocks at this point. Also, I think that at this point we're probably going to see some type of shift where you're going to go into, whether it's the small caps, wherever it is, you're going to see sort of that leadership and that theme start to assert itself here. I know we've basically had sort of the same theme that's lasted for quite some time, but at some point you're going to get another thematic shift, and you want to be ready for that. So that's about it. Let's see, we have Q&A tomorrow at 11:30 a.m. Eastern time with myself, Mark Ritchie, and Bob Weissman, and we'll see you then, and monitor the platform for updates, and let's see what the market brings us this week. All right, hope you had a good weekend, and talk to you guys later. Bye bye.